Good afternoon, and thank you all for joining us today to hear about the Trinidad and Tobago 2016 economic outlook. Joining us on today's podcast is RBC Caribbean Group economist Marla Dukeran. Marla, thank you very much for being here today. It is always a pleasure to have you here with us. So let's get started.
Sure. Thanks, Melissa. Thanks for having me. Again, it's always a pleasure to be doing these podcasts and webinars with you and for your clients as well.
Great. All right, well, let's take a look at, we've talked about this a lot. Trinidad and Tobago is an energy economy. And so the first thing we'd like to hear from you today, Marla, is about energy prices and what they mean specifically for Trinidad and Tobago.
Well, the thing is, Trinidad and Tobago earns about 80% of its export revenue from energy exports. And roughly, traditionally, about 40% of the fiscal revenue comes directly from the taxes paid by the energy sector. Now, we know that since the middle of 2014 or so, energy prices have declined. We're still seeing some declines every so often in the $20 to $30 range. And so, of course, that means that Trinidad is earning a lot less revenue from an export perspective. And also the energy companies are paying a lot less fiscal revenue in terms of taxes. But the other factors we need to consider when you're thinking about Trinidad's energy sector is that right now we have record low production levels. And part of the reason for that is because we've really had over the years a significant and secular decline in crude oil production. But also the producers, I think, are reluctant to produce at these levels. So we sort of have a bit of a deliberate reduction in production levels right now. So that's compounding the effect that the low prices are having. And then if you layer on top of that, as our Minister of Finance had announced recently, we have in our fiscal framework that governs the energy sector, the allowance for these energy producers to write off capital expenditure that they would have incurred over the past few years on, say, deep water exploration or any kind of capital expenditure that they would have had. And so what we're seeing right now is against whatever profits, which would be reduced, that these energy players are earning, they are writing off the capex that they would have incurred over the past few years. And so really they're not paying anywhere near the kinds of taxes that they used to. Trinidad, normally you would get about 25 billion TT dollars on average in tax revenue from the energy sector. And we're only projecting that we would earn about 5 billion. So we've lost about 20 billion TT dollars in revenue, taxation revenue from the energy sector. So that is actually having, I think, a combined effect, not just a price effect, but you have price, you have production, and then you have the taxation impact based on these write-offs. And those are combining to really hit us hard in terms of the fiscal revenues. When you have this drop-off in fiscal revenues from the energy sector, what it means is that what the government used to do in the past is take some of this energy revenue, of course, or all of it, and spend it in the non-energy sector, spend it on wages and salaries, goods and services, transfers and subsidies. And so it means that the government can spend that much less in the non-energy sector. And that is really driving the slowdown in the economy as well. So it's not just energy sector decline, it's also affecting the non-energy sector. So this is why we've had a contraction last year. And I'm projecting that we're going to have a contraction this year as well, based on these factors.
And when do you think positive growth will return?
I think possibly next year. The Minister of Finance had said that they want to balance the budget by the end of fiscal 2018. Which means we're going to run a deficit this fiscal year and next fiscal year ending in September 2017. But insofar as they really want to stick to this agenda of balancing the budget by say September 2018, it means that we're going to be facing some austerity. So that's going to be a big drag on growth. I think we're going to have negative growth this year and possibly negative or zero growth next year. So I think there might be a chance of slight growth next year, but if not next year, I mean, my guess would be safely 2018.
Okay, S&P imposed a negative outlook in December. What's your outlook for the rating?
Right. Well, both S&P and Moody's have us on negative outlook right now. They're both supposed to be doing their review next month or so. I think S&P is going to downgrade the sovereign rating for Trinidad and Tobago. They are about 3 notches above Moody's rating right now, and they've not adjusted the rating for quite a number of years. So I think S&P for sure is probably poised to give us a downgrade. I would guess maybe 1 notch. I've seen instances where they do more than 1 notch, but I think my base case is at least 1 notch. If it's 2 notches, I won't be terribly surprised, to be quite honest with you.
Okay. And we expect to see another fiscal deficit this year. What do you foresee in terms of deficit and public debt?
Well, the deficit that the government announced in October of last year, I think we're not going to see that deficit target being met. It really, the government had articulated 2.8 billion TT dollars or 1.7% of GDP for this fiscal year, based on the amount of expenditure that was, or should I say, the fiscal obligations that were incurred in the previous fiscal year, but were not honored in that fiscal year, that they have to now honor in this fiscal year. I think that's going to cause that 2.8 billion deficit to be in jeopardy. I think we're going to end up with a deficit that's far wider than 2.8 billion TT dollars. And that deficit was also premised upon certain capital transactions, divestments, and so on, special dividends, and so on, taking place, which we're not sure will actually come to pass. So I think that deficit, you might, when the Minister of Finance gives his update somewhere around March, April, I think he's going to tell us that we're going to look at a bigger deficit than 2.8 billion. I'm guessing maybe somewhere in the region of around 7 billion TT dollars. And that means that they're probably going to have to push back the date that they want to balance the budget by. They had said fiscal 28, end of fiscal 2018. I'm guessing they have to either push that back, or they're going to have to impose even more austerity than they had initially articulated. And in terms of debt, the last figure I saw from the central bank shows total gross public sector debt at about 115 billion TT dollars. Now, if you look at the denominator of a debt to GDP ratio, the denominator, which is GDP, is actually shrinking. It means our debt to GDP ratio is rising even if there's no more borrowing, which is, that's a scary phenomenon. So right now, that 115 billion is roughly 60% of GDP. That's counting all the OMOs, and that's counting all of the government guaranteed debt of the state-owned enterprises, so contingent liabilities, basically. So that's the widest measure of the debt that you can find. The Prime Minister had said he wanted to keep debt below 60% of GDP. I'm guessing he was referring to net debt to GDP, meaning excluding the OMOs, the open market operations, in which case that figure is around 47, 48% of GDP right now. So we don't have a lot of room to borrow, but given what I just explained about where the fiscal deficit is going, they're going to have to borrow. So we're going to see our debt to GDP ratio getting much wider very quickly.
Okay, you mentioned the austerity. Do you anticipate any impacts on employment?
Yes, we already are seeing a lot of impact on employment coming from the private sector, certainly the energy sector. Just today, there were further announcements of ArcelorMittal and BPTT, for example, laying off some workers. The Prime Minister had said he's not going to touch jobs just yet in the public sector, but I quite suspect that they will have to at some point, because if you look at what the government spending is basically comprised of, the largest line item in the government's fiscal budget is transfers and subsidies. We know that they've addressed the subsidy on fuel, on gasoline and diesel. We know that they've asked the ministries to each cut their spending by 7%. So they're trying to reduce that line item. The second biggest line item is wages and salaries. So I will be surprised if they don't try to address that line item sometime in this fiscal year, or for the very latest early in the next fiscal year. So I think unemployment is in fact going to increase, although we did see the latest unemployment statistics that I was able to find says that there was a small decline in the unemployment rate. So it went basically to 3.2% in June of 2015, down from 3.5% 1 year earlier. But that's because we had a 1.5% smaller labor force. I'm not sure why the labor force, meaning the participation rate, shrank. But if we had a similar size labor force than we did a year ago, the previous year, it means that we would have had a higher unemployment rate. So we were lucky that the denominator fell basically, as well as the numerator. So it ended up being that the unemployment rate fell to 3.2% in June 2015. But I quite expect that unemployment rate to go up.
Okay, and what's happening with the exchange rate? Could you tell us a little bit about what's driving the developments with the exchange rate?
Well, right now, today, our sell rate was 6.53 TT dollars to $1. The Central Bank of Trinidad and Tobago sets the exchange rate. It's not really market determined as in some other countries that have an adjustable rate. And so based on the inflows, as I mentioned earlier, we have a lot less inflows basically because 80% of our inflows come from the energy sector, and we don't have the volume of inflows that we used to. So we have slower inflows, but we pretty much have the same level of outflows in terms of imports for consumption and goods and services. So the central bank is trying to manage the reserves by repricing, or as we are saying, depreciating the TT dollar versus the US dollar. And I think that's going to continue. I don't want to call a figure because it would be speculative at this point, but it's perfectly rational for the TT dollar to depreciate right now, because we have smaller and smaller quantities of US dollars flowing in, and we have the same amount as we used to have flowing out. So there's a net outflow. We have a balance of payments deficit right now. And so it means that we need to price this precious commodity, which is US dollars, at a higher and higher rate. And what that means is that we're going to see some steady depreciation in the TT dollar versus the US dollar over the next year or so, is my guess, for 2016.
And how's all of this going to impact price inflation?
Right. Well, it means that all of our imports that used to cost, let's just say you would buy an apple that cost $1, it would have cost, say, $6.35 TT. It now costs $6.53 TT. So it means that all the goods that we're importing will cost more in TT dollar terms. So you have your local merchants paying more TT dollars for everything that they put on their shelves. So they're going to have to price those items higher. So that means that you're going to have supply push inflation driving the prices higher. The other thing is, that might affect inflation right now. As you may know, the government adjusted our VAT, our value-added tax system. We no longer have a 15% headline VAT rate. We have a 12.5%. So the VAT rate itself came down. However, they added on this VAT to many more items that used to be previously exempt or zero rated. So it means that a lot more goods and services that did not attract VAT in the past now attract a VAT. So it means that that is also going to drive some of the inflationary impact that we're seeing now. And that, I think you're going to see inflation go up in the next few months until such time that the demand side shows some slowdown in consumption, and that might temper some of the increase we're seeing in inflation. But my assumption right now is that for the next 6 months or so, we're going to see inflation going up based largely on the VAT impact and also the depreciation of the TT dollar versus the US dollar.
Okay, and I'd like to hear a little bit too about domestic interest rates. What's your outlook on domestic interest rates, and what are the implications?
So the fact that the government has to borrow all of this money, as I mentioned earlier, to finance this wider deficit based on spending that took place or obligations incurred in the last fiscal year, the government has to come to the market to borrow. We have, the last time I checked, we had excess liquidity in the system of about 3 billion TT dollars. The government is going to have to borrow quite a bit more than that. So the fact that we have tighter liquidity because the government is borrowing means that interest rates would tend to go up. Now, the central bank had been increasing the repo rate, which is our policy rate, about 8 times consecutively by 25 basis points each since mid 2014. The last monetary policy announcement, though, the central bank paused on increasing the repo rate. So that means to me they're probably weighing the fact that the tighter liquidity means interest rates are naturally going to have some upward pressure. So they're probably cognizant of the impact that that's going to have on overall consumption growth, overall credit growth, and overall economic activity. But basically, I think interest rates are going to continue to rise, even though the policy rate is not going to go up. I think because of the amount of borrowing that the government has to do, it's going to cause interest rates to rise. And that's going to also cause private credit growth to slow down because you have the government crowding out some of that private borrowing and also higher interest rates causing some of that private borrowing to fall as well.
Marla, how can TNT avoid a recurrence of the situation in the future, where the slump in energy prices drives the economy into recession?
Well, Melissa, the answer to that is diversification in the first instance, but diversification seems to be such an elusive goal in this country. We've been talking about diversification since before you and I were born. But the other thing is, I think what we need to be cognizant of is that we have a problem in Trinidad where we have decidedly pro-cyclical fiscal policy, meaning that when the economy is booming, the government spends more. When the economy is in decline, the government imposes austerity measures, which is exactly what we're seeing right now. And what that pro-cyclical fiscal policy does is that it amplifies the natural movements in GDP that would be brought about by energy price fluctuations. And we really don't need an amplification of that volatility. So what we really need, separate and apart from diversification, is we need counter-cyclical fiscal policy. We need the government to save when we have a boom, especially an energy-driven boom. Therefore, if they save during an energy-driven boom, when there is a slump, the way we have now, they can spend more to make up for the shortfall in energy revenue. And a good way to make sure that we have countercyclical fiscal policy is to impose fiscal rules. We would have seen that Jamaica has imposed fiscal rules under the current IMF program that they have in Jamaica. I don't know of any other country in the Caribbean that has implemented fiscal rules outside of an IMF program. But if you look at the way it works, it really sets limits on your deficits. It sets limits on the size of your debt burden. And there are some escape clauses built in there for when you have a disaster and the government needs to respond. But in general, what it means is that it ensures that the government does not get into a runaway spending pattern when there is buoyant fiscal revenue. So I think, in the absence of immediate diversification, which of course cannot happen in the short term, I think fiscal rules and countercyclical fiscal policy can certainly help to alleviate the volatility that we see in the macroeconomic performance because of oil and gas prices.
Great, Marla. This has been an excellent conversation, and I really appreciate your time and insights. Again, that was Marla Dukering, Group Economist for RBC Caribbean, and I am Melissa Marchand from Global News Matters. Thank you so much for joining us today.
Thank you.